real estate and luxury properties can go well beyond just providing their owners shelter. And likewise, the mortgages that buyers and owners of these properties use can go well beyond the fixed rate loans that are common to the rest of the market. I find that with jumbo mortgage borrowers in particular, interest-only loans are both popular and in demand. So today, let's cover how interest-only loans work, some of their pros and cons, and if they're a good fit for you. Hey guys, welcome to Rockin' Real Estate. I'm Rob Spinoza, residential mortgage loan originator. If you're a home buyer, a homeowner, or a real estate professional looking for home finance tips, tricks, and your favorite guitar licks, I've got your backstage pass to better understanding the mortgage business. Before we talk about the details of interest-only loans, let's first compare and contrast them with the most common loan program out there, the 30-year fixed-rate mortgage. With that program, you have a fixed rate and 360 identical payments if you hold the loan to term. Each mortgage payment is comprised of both principal and interest, and the loan is amortized, meaning that as time goes by, you pay down the balance of the loan. And if you hold the loan for all 30 years, the balance will be paid in full. But when you have an interest-only loan, you're not paying any principal at all, at least not for a set period of time at the beginning of the loan's term. This can be attractive when loan amounts get very large and where there's no longer-term objective to pay off the home. Interest-only loans free up the borrower's cash for other purposes, though they do so at the expense of not paying down the balance of the loan during the interest-only period. Most interest-only loans are hybrid ARM programs, like the 7-year or 10-year ARM. And most often, the interest-only period coincides with the fixed-rate period at the beginning of the loan's term. Once the rates on these programs enter the adjustable period, they often become fully amortized as well. It's not unheard of to have a 30-year fixed-rate interest-only loan, and in cases where that exists, the interest-only period tends to run for the first 10 years, followed by 20 years of amortized payments, but with a fixed rate the entire time. So at this point, you might be asking yourself, if interest-only loans have a lower payment, why doesn't everyone use them? And this is a great question. Mostly the answer lies in the fact that interest-only loans are considered non-QM loans or non-qualified mortgages, and therefore lenders must underwrite them to a significantly higher standard. Therefore, they're harder to qualify for. Interest-only loans also tend to have higher interest rates relative to their fully amortized counterparts. When we take into consideration that it can be materially more difficult to qualify for an interest-only loan, and when we take into account that many borrowers are simply not comfortable making a mortgage payment each month and not seeing their balance decrease, these factors together, along with the reality that most interest-only loans are ARM programs, we can begin to understand why this product appeals to a market segment rather than to the broader home buying and home refinancing public. So where might an interest-only loan be a good fit? In general, applicants for an interest-only loan benefit from having higher FICO scores and lower debt-to-income ratios, as well as sufficient asset reserves. This last point, reserves, refers to the amount of money a borrower has after they make a down payment and pay their closing costs in the case of a purchase. Interest-only mortgage borrowers should have a very good grasp on their financial situation and objectives, and a sufficient risk tolerance for taking on an ARM loan. As we said, most interest-only loans are ARMs and not fixed. Last, remember that just because you choose an interest-only loan, it doesn't mean you can't pay down the principal balance of the loan during the interest-only period. One of the advantages of ARM loans and interest-only loans is that their monthly payments may go down if you reduce the principal balance of the loan during its term. And this happens even without a refinance or a recast of the loan. For the right borrowers, interest-only mortgages can be a financially effective loan product. And if you have questions about them, want to know how to calculate an interest-only payment, or wish to inquire about any other aspect of the mortgage process that will get you the financing you need, don't hesitate to get in touch at any of the contacts below or by calling us directly at 415-367-5959. And if you found today's video helpful, please click on the like and subscribe buttons below, and we'll keep the hits coming.